Good afternoon, everybody, and welcome to this edition of our Think Learning webinar for 13 Jan 2021. We're kicking off our it's the first in the series, isn't it, for this year, and hopefully first of many chances to interact with our Think Markets clients, both existing and prospective. My name is Carl Capolingua. I'm the market analyst over here at Think Markets, and it is certainly a pleasure to be with you. The topic today is three sectors to watch for 2021, and we'll have a look at a few stocks within those sectors as well. So obviously discuss why I've chosen the three particular sectors and some opportunities within those. Firstly, we'll talk about the opportunity that Think Markets offers you, a fantastic offering for ASX share traders, $8 flat rate trades, your own personal holder identification number, and unlimited phone support, so you don't have to get onto those chat bots and bang away and hope there's a real person at the end of it. You can give us a call 24/5 and no hidden platform or subscription fees. So 4 fantastic reasons, and I'll give you 10 more if you switch to us before Jan 31. You'll get your first 10 trades free as well. So 14 fantastic reasons to make sure your next ASX share trade is with Think Markets. The agenda for today is to obviously pick 3 sectors which I think will do well in 2021. We'll, as the last point suggests there, we'll have a look at some other sectors which can do well also. We'll discuss some of the macro themes that are in play at the moment. Haven't had a chance really within these Think Learning sessions yet to discuss really what has happened in 2020 and then see where we are heading into 2021. And then the 3 sectors that I'll be looking at today are the consumer discretionary, technology and materials sector in no particular order. Okay, COVID situation, this is just from a few days ago, but it really hasn't changed. And the reason why we're having to pick 3 sectors which will outperform this year is because of the huge implications that this situation had for 2020. The word unprecedented was certainly bandied around many times, and it probably was applicable actually for 2020, and as we'll see when we investigate the impact that COVID had on the global economy. But just at the moment, we're looking at well over 200,000 cases per day being found in the United States and Europe, and we can see some of the shapes of those curves are certainly disturbing. So the point I want to make here obviously is, number one, the huge impact that it's had, and number 2, that just looking at those charts and taking into account that we do have the prospect of some effective vaccines working their way into populations in 2021, I think this chart tells us that this problem is not going to go away anytime soon, and that will, I guess, shape this discussion today. Okay, so looking at the impact that the pandemic has had on the global economy, we'll start with the world's biggest economy at the moment, and just underneath me is a little flag there of the USA for your reference, and in a couple of slides' time there'll be one for China. But looking at the USA, these are non-farm payroll, so this is number of jobs created or lost within the US economy, and the standout, of course, is this big red blip from April, and you can see there now this, okay, so these are millions here, these are millions of jobs lost, and it's quite extraordinary when you think, and I have to do a double take when I say that over 20 million jobs were lost in April. Now we've added back many of those, and you'd have to add up all the bars to see how many, but we're still missing somewhere between 5 and 6 million jobs from the US economy. The underemployment rate is probably a good measure really of where we're at, and that's sitting at around about 11 to 12% at the moment, and that is quite different. I just wanted to highlight the difference between the underemployment rate, so it's people that would like to be employed more than they currently are, is considerably different from the headline rate, which is, you might say, well, that's not that bad at 6.7%, but there's still a long way to go in repairing the US economy, and much needs to be done, and it's illustrated further in these charts here, which show you the current situation, which is the green line down here, and you can see how big an impact on unemployment that this coronavirus pandemic has had compared to, for example, the GFC, which is here, and really all the rest of the US recessions. So we have obviously added back some jobs, but we've taken ourselves to the point where we're basically at the depths of the GFC. And it took a lot longer to get to the depths of the GFC than we have, obviously, in this crisis because of the sharp and substantial hit that COVID had on the global economy. But the point I want to make is how long it took to get back to normal from the GFC, and we're really just now at the worst point of the GFC. So there's an incredibly long way to go in terms of repairing the damage. That creates a lot of slack in economies, and it gives it stimulates lawmakers and central banks to stimulate the economy further. Having a look at how the markets have reacted. So this is, I guess, on this side is more the economic impact, and this side is more sort of the stock market impact. And we can see that, and we're comparing here to the GFC, which was within recent memory the most severe financial crisis that we've had. Obviously, we had a shorter and sharper decline than in the GFC, and that might surprise a few people. But the recovery has roughly tracked along with our GFC recovery, both in terms of magnitude and timing. Let's get to the point on this one. Well, potentially, if we're going to follow history, and hey, they say that history doesn't always repeat, it kind of rhymes, and that's what we're seeing today. Potentially there's another 30 plus percent to where that GFC recovery, quote unquote, completed, and it would match obviously with that one there. Well, I guess one other way to look at that is we've actually had a considerable chunk of the recovery already behind us. Okay, but there's still, I think, potential upside if that historical situation is to repeat, and I would suggest there's a high probability. You can't say it's guaranteed to repeat, but there's a high probability to repeat because central banks and governments are taking similar steps to solve the problem as they did previously, perhaps even a greater response this time around, as illustrated by the chart on the right and some of the points on the left. So we're looking now, if we would call, and I'll just go back a slide here, and just narrating some of these moves in slides so you don't get confused about where we're going. So we've gone back a slide, and if we call this the mother of all recessions, well, potentially it's going to breed the mother of all bull markets. So the Federal Reserve, that's the US central bank, and I've got plus rest here because they're all acting in quite a similar fashion. Okay, so official rates effectively to zero. We've seen negative rates, market rates at least in some other jurisdictions. But in terms of how long those rates are going to retain low, and that's the key. We want to try and keep looking forward here. And the Federal Reserve says until the labour market conditions have reached maximum employment, so that 6.7% would need to get down to around about 5%. But we may even go longer than that because of that underemployment rate. The Federal Reserve would love to see that get down really into sort of mid-single digits as well. Or inflation exceeds 2% for some time. There's been a little bit of news in the media lately about inflation expectations creeping back up. They have gone up and they're about 2%, but I don't think that's going to bother the Fed. So I think we've got accommodation from central banks for the foreseeable future, and that should be conducive to getting the rest of those equity price gains that we talked about before. I think this is interesting, open-ended. So in the GFC, they said, look, we're going to buy certain amounts for a period of time, and now this is just basically we're just going to buy securities. So we've got government securities, so for example bonds, treasury bonds, and mortgage-backed securities. So these are market-based securities as well, in the magnitude of $120 per month, basically until I guess this situation is met. That has increased the Fed's balance sheet from about 4 trillion pre-crisis, it wasn't small, to about 6.6 trillion and counting. That's the December number. And they are also direct lending to banks and corporates, where other banks where the market is not prepared to lend, the Fed is stepping in as well. And the result of that, so we've got a lot of words on the left and we look at the picture on the right, the result of that, and I said it's the rest here, obviously, it's coordinated around the world. We are seeing a massive spike in money supply. The amount of money sloshing around global economies really I was going to say, what's this? The green one there in the US. There you go, at unprecedented levels. There's that word again, unprecedented. So this is going to go all over the place, of course. Some of it's going to get stashed under the mattress. Some of it's going to go into alternatives like Bitcoin. We know that's done very well recently. Some of it's going to go into hard assets like precious metals as a hedge against the inflation that is predicted down the track. Just me, I'm not so sure we're going to see that inflation. We haven't seen inflation for the better part of 30 years. I don't see why it would all of a sudden appear now. And it's going to go into real assets, so real estate, metals, so industrial metals and the like. And of course, some of it, get to the point, Carl, is going to end up in the stock market. This is the GFC, right? So in terms of US money printing, we're well ahead of that. So unprecedented times, unprecedented responses, and potentially an unprecedented bull market to come. Now, what we didn't have last time, this is kind of the kicker, is government spending. So it was largely a central bank response last time. Yes, of course, we had a few cash splashes here and there, but we didn't have this degree of coordination between banking and government. Now, we've got US President-elect Biden on the way in, and he will give us some details tomorrow night, actually, Sydney time, on what he wants to do. But these are the predictions, and based upon some of the noises that the Democrats have already made, we can expect about $3 trillion coming, including an increase in the stimulus payments from the current $600 that President Trump approved up to $2,000. He wants to extend the crisis unemployment supplement payments from $300 to $600. There's support for small business, city and state governments, rents relief and forbearance, and this is another big and important one here, which we haven't got many details on yet, which is the potentially $1.5 trillion infrastructure spending, plus investments in clean energy, sustainability and innovation. Now, how is he going to pay for this? Well, this adds up to $2.8 trillion over 10 years, and this is $3 trillion probably going to hit the economy over the next year or two. So that suggests he's going to struggle to pay for it. But he's proposing to increase the top personal tax rate from 37% to 39.6%. You'd need to earn over $400,000 for that to impact you. So I don't think that's going to hurt him from a voting perspective. Company tax rate from 21 to 28%. Markets are looking past that, and a 15% minimum tax rate on companies earning 100 million. So it doesn't matter where you're based now, whether you're Google, Apple, or etc., Facebook, or etc., wherever you're paying your tax, you will have to pay 15% minimum tax, and that is designed to catch those who are trying to keep the money away from the US tax man. In terms of GDP predictions, and the central one is the mean, is the average, and then you go sort of standard deviations away from there. But we are predicting, and this is the middle of the year here, so that's the end of the year and the end of the year, so that's the end of 2020 here, and that's the end of 2021 there. So just give you an idea of where we're at. So we're obviously still tracking lower there, but expecting to be exceeding where we were pre-crisis by the end of 2021 because of all the stimulus. And, this is sort of average projections, and they aggregate a number of different research providers to come up with these. So we are expecting significant growth down the track because of all this stimulus. Bringing it a little closer to home, I've to get to move on, just looking at the time, just looking at the impact on China, and I want to talk about the manufacturing and services sectors, the two key components of the Chinese economy. We are back to or above pre-COVID crisis levels, as is consumer sentiment, almost as good as it's ever been. So that would bode well for the Chinese economy. And then one of the sectors we're going to talk about later, which is the materials sector. So we've talked about the mother of all recessions. We've talked about the mother of all responses, and does that create, therefore, and then I have strategically put that question mark there, the mother of all opportunities. So we're looking for winners potentially, and I think you have to look where the winners were for 2021. So we started off this discussion with saying that the COVID crisis has had a major impact, but clearly looking at the numbers, and notwithstanding any positives from vaccine rollouts, which markets have factored in almost a perfect rollout of vaccines, and there's so many things that can go wrong there. I have to think that the impact is going to be sustaining itself through 2021, and therefore I think that we should be looking in similar places to where we looked in 2020. And many might argue, we're going to rotate back to value and cyclicals and things like that. And I think there's a case for each. Certainly, in terms of cyclicals, we look at the stimulus that's to come. I can certainly see that, but I think there's more time and more upside left in these, and probably to a larger extent, therefore, than some of those other plays. Okay, so we're going to look at consumer cyclicals, which is otherwise known as the consumer discretionary sector, the technology sector, and commodities / the materials sector. Just translating how these concepts relate back to actual sectors on the market. We'll kick off our discussion with the cyclicals with this chart here on the right, which just shows what savings rates have done through the crisis. So saving rates for Australia, which I'm pretty sure is that green one there, it was about 4%, of household income got saved, and it's now at 14.4%. So that is a massive jump in savings. Part of it's to do with the fact that we can't travel internationally, and even here domestically now, so that money is being saved at the moment, and part of it obviously being spent elsewhere, and you can see savings rates jumping around the world. And this can fuel, I think, a surge in retail spending in certain areas through 2021. We know it's already happening. It has happened in 2020. International travel spending diversion, and of course many people staying at home now. They're forced to be at home. They're looking around and they're thinking, I need to fix this place up. So we've got the All Technology Index locally, or the Information Technology Index here in Australia. I probably should have mentioned that it's the XDJ. XDJ is the consumer discretionary sector, the best proxy for consumer cyclicals. Here we've got the XTX for technology, or the XIJ. I like to look at the XTX. And in terms of why I think technology is going to continue to feature, well, we know it's done very, very well in the lead up to the crisis, but I think many subsectors found their niche during the crisis, and where I'm zooming to you right now for good reason, because I can't be in the office. So the only constant in life is change. Technology facilitates innovation, and what we saw through the crisis, more importantly, I think, adaptation, and people are they're being forced through the crisis to use certain technologies that they weren't potentially going to use for a period of time, and that increases their adoption of those technologies. For some existing digital trends, the pandemic obviously is beneficial. For others, it is largely irrelevant. Those things were going to continue no matter what. For example, the move towards using artificial intelligence, cybersecurity, etc., etc. Okay, in terms of commodities, the best proxy we have in the Australian market is the XMJ materials sector. And it's a very broad church, so it contains industrial metals like BHP, Rio, Fortescue. It contains gold stocks. For example, Newcrest Mining, contains materials, construction materials, I should say, like Adelaide Brighton and CSR. Of course, we're talking key themes here. We're talking about China strength, which I expect to continue, partly because of the unprecedented stimulus within that country, but also more broadly around the world. And a lot of it is to do with an infrastructure focus this time around. So we talked about Biden's $1.5 trillion infrastructure spend, and to a lesser extent, obviously, that's being reflected even here in Australia. And we want to play that economic recovery. We've talked about the growth that's going to come out of this, so we want to have an exposure there. Okay, let's have a very quick discussion of the consumer discretionary sector. Subsectors within consumer discretionary to target are automotive, fashion, gaming, home improvement, including furnishings, electronics, and hardware. Notice I haven't included other subsectors like travel and education, because I don't feel that they are going to have their time in 2021. And we certainly may be doing 3 sectors to watch in 2022, and they may well be on that list. But I think it's going to be the status quo, I think, for 2021. Okay, let's have a look at some of the current sector buys that we have here at Think Markets within these subsectors. When I say we have a buy on them, they have been covered in our Think Technical section, which we regularly update to the market news section of the website, and I'll show you the link for that a little later on. So each of these stocks have been figured at some stage in the recent past, and I've gone through and reviewed the rationale for calling them a buy, and I still think there is a good reason to investigate these stocks. So looking at the automotive stocks, we've got ARB Corporation, so they do four-wheel drive accessories, amongst other things. About Corp, so automotive parts and accessories. Fleetwood Corporation, a little bit of an asterisk against that one. It's not strictly an automotive company, but they obviously do camper vans, recreational vehicles, they call them. So I've included it there. National Tyre and Wheel, I think the name says it all there, and Super Retail Group. Again, automotive parts and accessories. And the rationale for that, you would have no doubt already heard about the fact that people are gravitating more towards cars and keeping their older cars going. We still are in a crisis, so you're more likely to keep your old car going, and you want to drive it instead of catching the train now because you don't want to get COVID from the person sitting next to you. Fashion, we are looking at City Chic there, Lovisa Holdings, Redbubble and Universal Store Holdings. And again, this is the diversion of travel spending. So we've got dollars that we're not spending on travel that we are looking to spend on ourselves to make ourselves look nice. Gaming, I think whether you agree with this or not, you might have some moral or ethical objections to this sector, but unfortunately, with people staying at home, they are betting more. The first one, not as much. I think that's maybe a bit more of a positive one because you might be going out to the local Crown Resort and having some rest and recreation there because you can't do it in Bali for the foreseeable future. But that one's starting to look quite good. Crown Resorts is more of a turnaround play. Jumbo Interactive, that's the lotto provider there, and PointsBet Holdings, we've all seen the ads for that one. In terms of home improvements and furnishings, electronics and hardware, I like Adairs still. Beacon Lighting, Harris Technology, it's sort of an e-commerce provider. I could have easily put that in the technology section as well. Harvey Norman, well known. Nick Scali, I've talked about that many times. Temple and Webster. And Wesfarmers might surprise a few people, but of course they do have Bunnings and Officeworks, so a large component of their earnings coming from the retail space. Okay, let's move over to technology now. We're going to talk about some of the subsectors to target. Artificial intelligence. Now, I mentioned some of the technological underlying themes and where they were going, and this one I don't think is going to be impacted by COVID anyway. It was the market was moving towards this. Artificial intelligence is going to permeate every part of our lives, from us walking through a shopping centre and finding marketing targeted to us as we walk through, all the way to driverless cars, so self-driving vehicles, and the ability for the computer to recognise a pedestrian and not hit that, and recognise a freeway exit and hit that, kind of. You know what I mean? Of course, cybersecurity, one of those things which, regardless of COVID, was always going to be a growth industry. E-commerce, this is probably more of a COVID play because we are being forced to go online, I should say, rather than do the traditional bricks and mortar. And wherever you are in the world, if you're in Australia, you might not be thinking that's as big a deal, but certainly if you're in the UK and parts of the US, that will continue to be an issue. And then networking and cloud services is one of those areas that we're going to do well regardless of what's happened with the pandemic. A couple of stocks here to look for: an artificial intelligence, Appen, which I think from a fundamental perspective is absolutely fantastic, but I've put an asterisk there because the chart just isn't matching that right now. So I have to respect my methodology, which is to find stocks which are fantastic on a fundamental basis and then wait for the charts to look good. So I'm putting that one on watch, but we have had a buy on that in the past, and if you had it, I would hold on to it for now. But if you're looking to buy, I think we need to make a base pattern and then turn higher before it's becoming a buy again. Drone Shield, they do, counter drone technology. So if you are an industrial conglomerate and you want to protect your trade secrets, you don't want to see the competition's drones flying over your warehouse or whatever it is, or your factory yard, you may employ the services of Drone Shield to keep those drones out, or more importantly, if you are a sovereign nation, so military applications as well for that. And they do have a lot of that is to do with artificial intelligence. It's also sort of a defence one as well, so it's a bit of a crossover stock there, as are many of these, to be fair. For example, AVA Risk Group, certainly it's cybersecurity, but they do monitoring for conveyor belts and things like that. And White Hawk is a broad cybersecurity company, but with some e-commerce applications as well. In terms of e-commerce, Frontier Digital Ventures is my key pick there. I think it's looking very, very good on the chart as well as the fundamentals. And they do car sales, for example, but in a number of emerging markets. Kogan, we all know what they do, so keying off that retail theme as well. But a Kogan marketplace, which is a bit like Amazon, it's a lot like Amazon, is starting to look very interesting as well. Smart Bay Holdings, so e-commerce, facilitating e-commerce through technology. IT, networking and cloud services. So Dicker Data doing well because of that work from home theme. So they are probably the best company, in my opinion, at the moment to take advantage of that theme. And we've got Dropsuite and First Cloud Technologies. A couple of speckies there, so go check those out. Smaller capitalisation stocks that are helping businesses transition and provide services to customers in the cloud. And now this is a very, very general and broad overview because it's more about the sectors and the specific stocks, and no doubt we'll do other webinars during the year and we'll dig down into some of these stocks. But keeping it very broad at the moment. Subsectors to target for the material sector, industrial metals, precious metals, and coal. And I put an asterisk there because it's some of these coal stocks are in the material sector, and some of them are actually in the energy sector. So I'm being a bit cheeky by putting that in there. So we're looking at BlueScope Steel here as well, from that infrastructure play. Nickel mines, well, what goes into steel, and nickel actually also being used in electric vehicles as well, and batteries. One of the more famous quotes in 2020 came from Elon Musk, who said, "Hey, if you've got nickel, we want more of it." New Century Resources, which is a zinc company, and they have that Century Zinc mine in Queensland. They're looking to go cash flow positive very soon, and going to have actually significant cash flows coming online. So definitely look at that one. Nickel Mines actually is a very, very strong company from the fundamental perspective as well. And South 32 also has that coal exposure as well, but a number of industrial metals. It also has some silver as well. In terms of precious metals, and this is a bit of a tricky one this year, the chart of gold doesn't look fantastic, but we talked about money printing, we talked about governments and federal and central bank spending, and there is a strong case to talk about gold this year. So certainly looking for gold to turn around in 2021 at some stage, and this is one to check out, Gold Road Resources. And in terms of coal, Coronado is one we like, and Whitehaven as well. Our coal prices have turned higher in recent times. I better get moving because I can hear the noise. Best of the rest. Look, financials I still think are worth looking at. Energy is definitely a sector I'm interested in this year, and property trusts as well, but maybe we'll save that for another webinar. Okay, thank you for joining me today. The replay of this presentation will be put up in full to the market news section of the website. You can see the link there. If you'd like, you can follow me or the Think Market handles on Twitter. And in terms of upcoming events, I said earlier that this is just the first of a series of webinars we'll be holding this year. They are the ones there for January and the first half of February. Our weekly think tank is just a regular weekly review of the week that was and a look to the week that will be. That will be on Monday. And next week you can join me at the same time. It's called Ask the Experts. It's just me this time around, but during the year we'll have some guests on, and you can ask myself and the guests about stocks you're interested in right now. So just literally type in to the chat window one you're interested in. We'll have a look at the technicals and fundamentals for that. And then the next structured webinar will be how to create an investment plan on that. I'm pausing here because I know there's another one in between there, I think, on technical analysis, and the investment plan is coming, I think, on the 25th of Feb. So 10th of Feb should be technical analysis, and then that how to create an investment plan will be the 25th. Okay, the disclaimer before I leave you says that everything we've talked about today is general advice. Please consider it carefully before you act upon it. We are a regulated Australian broker, and we do have some products that could see you lose more than you deposit. So read this disclaimer carefully. Give us a call, of course, if you have any questions, or consult the website for further details. Thanks so much for joining me today. Hope you got lots out of it. All the best for your trading. Until we catch up again, bye-bye for now.